How's it going, everyone? It's Sam. Today I'm going over 6 stocks to buy or just to watch. So I'll let you do your own research, but I'm going to present to you 6 stocks that I think are a good value right now. And they're in all different sectors. They're different kinds of stocks. Some have dividends, some don't. I think are all really quality stocks. And what I'm going to do is show you where the price is now. So talk about the stock price. Talk about the financials for each of these because you got to get down to the root of their financials to really understand what kind of position they're in going forward, especially right now with the economy. And I'm also going to go over kind of an intangible value that they have or some exciting opportunity that doesn't get captured in their financial statements. So I'm excited to go through each of these. I'd love to hear what you guys think of these below and what stocks you're really looking for and looking towards to get some good gains or dividends. And I'd be interested in hearing from you. Also, if you don't mind hitting the like button, that really helps out the channel. It's right down there. And then also, if you haven't already signed up for WeBull, you can get 2 free stocks, one worth up to $1,400. They're also doing a promotion right now where if you deposit like $5,000, you get extra stocks, and then it's tiered. So if you move over more money, you get more stocks. So if that's something that you're interested in, check it out. But we'll get right into it here. So the first stock that I have on here is a little bit more of a speculation play, a little bit riskier, I should say, not really a spec play. It is Cheesecake Factory. So this was about $42 4 months ago, and now it is sitting right at $22, and it's down about 50%. I think this is a quality company because they have first of all, they have a couple different food chains. The main one is Cheesecake Factory, obviously, but taking a look at their revenue, they've been increasing it pretty consistently over the last 5 years. They are about $1 billion market cap company. Their net income has been pretty steadily increasing, or just right around the low to mid 100s. And it's a quality company because you're buying it at $1 billion. They have a net income of about 150 million. So it's right around a 7 to 10 PE ratio. And right now you have to realize they're not going to be earning as much as they were before, but they've transitioned a lot of their business to carry out. And this is a company that I think is going to come back pretty well. They're one of the larger food chains, so they're going to be able to get lines of credit. They're going to be able to get loans if they need it. So they have about 81 million in cash. They have about 100 million in receivables and then 270 million in inventory and prepaid expenses. So overall about 450 million here. And then they have current liabilities of about 500. So not exactly what you want to see, but like I said, I think that they could get some more debt or more credit if they needed it. I think that they are going to be a solid play because I think a lot of the smaller companies and the smaller restaurants are probably going to go out of business, honestly, just because it's going to be really tough going forward when we come out of this. And I think that Cheesecake Factory is going to do just fine. They are one of those large companies that will be pretty resilient. And in good times, they do have a nice dividend of about $1.44. The next company that I want to talk about is Berkshire Hathaway. So this is one of the largest companies in the world. They have a $460 billion market cap. If you don't know who they are, they're Warren Buffett's company. And they are a conglomerate that has just a massive amount of companies underneath it. They own a lot of companies outright. They own even more companies, just shares in the companies, but they own billions upon billions of dollars in tons of different companies that you would know of. A lot of bank stocks, a lot of dividend paying stocks. And just looking at their income statement here, it's amazing to look at. I mean, it's so consistent. 201 billion, so this is not in millions, this is in billions. 216 billion, 240, 247, 256. It's just a company that really focuses on good quality stocks and good quality companies that they're buying. They're not trying to buy the next workhorse or the next Tesla. They are just buying companies that make good money and trying to buy them at a discount. The other thing about Berkshire is they hold a massive amount of cash. So as you can see here, they hold about $140 billion in cash, which is just massive. I mean, that's almost a third of their market cap that they have just in cash. This really gives them a competitive advantage. So if a company comes to them and they're distressed or they need money, Berkshire can either lend them some money, they can buy the company outright, they can buy some shares. they can do just about anything because they have a massive war chest to be able to buy these other companies. This is really significant if we go through another difficult time, and even if we don't, if we go back to a booming economy and a booming stock market, Berkshire is going to do well because they have so many different companies underneath them that they're essentially an index fund in and of themselves. So if they go through tough times, they're going to be able to capitalize by buying really cheap deals, and if we go through good times, they're going to be able to take advantage because so many companies that they own are going to do well. The next company is JP Morgan. This is a company that I've talked about in my dividend series. I can link that here, but I go through and invest $100 a week. They are sitting around $100 now. They were $140 before, so they're down about 30%. They are one of the largest banks in the United States. If we go to their revenue here, they went from 89 to 91 to 94 to 104 to 110. Probably going to be down this year a little bit from these numbers because of the fact that they're losing some money on different loans that aren't being repaid, and because the Fed dropped rates. So whenever the Fed drops rates, it really hurts the banks. So we're at a very low interest rate environment. If you've noticed that on your mortgage or your credit cards or anything like that, it's difficult for these banks to do well in these types of situations. But as we can see here, this is a really stable company. They've been increasing their bottom line and their top line. They pay a nice dividend. They probably won't have to cut their dividend. And they are just a company that's really solid. I think that they'll get back up to 140, 150 here in the next couple years. Now, I will say the fact that they have cut the rates, the Fed has cut rates, hurts JP Morgan, but you're also going to be able to buy it at a discount from what it normally is because they aren't going to make as much money in the short term. So once they start raising rates again, JP Morgan Chase is going to do really well. A lot of the other bank stocks are going to do well. That's where you can see the stocks really start to jump higher for these bank stocks. So I am a buyer of JP Morgan and I'm excited to own them. The next stock is Planet 13. So this is a company that I've talked about a handful of times on the channel here. They have jumped really significantly. They've jumped 35%. And this is just a company that's a really good growth company. No pun intended. They're a dispensary over in Las Vegas. They are the largest dispensary in the world at 112,000 square feet. And it's just an awesome place to go, as I hear. I think that they're going to do quite well in the future. They're trying to expand to 5 or 10 locations. I'm getting more bullish about this stock the more that I talk about it and the more that I think about it. And I might have to make a video here in the next day or two just because I might buy some more shares. The more that I think about it, the more bullish I am on it. And just looking at their sheet here, their income statement, they went from 1.5 million to 9 to 21 to 63. This is all in one location because they only have the one location right now. Their net income has been back and forth a little bit because they are growing. So a lot of the time when these companies grow, they don't make a good amount of net income. A lot of the time they're negative net income for a while because they're trying to expand. They have about 14 million in cash on their balance sheet, and they have total current liabilities of about 14 million. So they're not in a bad situation. They would be able to raise some money, I'm sure, too, if they wanted to. And I'm sure that they're going to continue to issue shares out because they need to be able to expand if they're going to expand to 5 or 10 locations. But I think that this is a company that has a real chance at growing over the next 5 to 10 years. I think that they are in a really good situation in their industry, and I think this is an industry that's just going to continue to grow over time. And if you want me to do that dedicated video to Planet 13, please let me know in the comments below, but I'll probably do it because I feel the need to buy some more shares. Now the next company is Realty Income. They were about $82, and now they're just about $57, down about 30%. They are one of the highest quality REITs out there. They are about a $20 billion market cap company. They pay about a 5% dividend, and I was able to pick up a good amount of shares when they were around $50. I picked up some more around $55, I believe. They have triple net leases. That means that they don't have to do a lot of the expenses on the buildings. The tenants have to do that. They also have to pay for the property taxes and insurance. So Realty Income doesn't get bogged down with a lot of that. As you can see here, their revenue has consistently increased. They also have really good net income, 290, 315, 319, 360, 440. That's just something that I love to see. And as you can see here, the earnings per share is also going up. One of the other things that's important to look at on REITs is the FFO. So REITs can be kind of misleading with their depreciation, so you want to see the FFO go up in value each year, and as you can see, they've been doing that too. Now, they have a lot of positives, but I'm just going to use this article here because there are a lot to cover here, but they have really long leases. They typically are 10 to 15 years. They don't have those landlord responsibilities like I talked about before. They have triple net leases. They have pretty good growth, so they've been increasing rents about 2%. They're pretty resilient in recessions. Like we said, they're long leases, so that really helps. And they are just so quality. I mean, they've paid 601 consecutive dividends, I think I saw it. And they've been growing their dividend for 26 years. They pay monthly dividends too, so the fact that they've been able to grow it for 26 years, they pay monthly dividends, it's really attractive to dividend investors, and I really like holding them myself. So that is another company to look at. Then Foot Locker is my last company. They were around $42 a share, $41 a share. They are down about 34% to $27. I bought a good amount of Foot Locker when they were $20. I was able to buy in here a lot. If you don't know, they also own Champs. They also own East Bay, so they have multiple brands. They're about $3 billion in market cap. They have cut their dividend in the short term, but think about stuff that is going to transition online, and I don't think that buying shoes is going to transition online as much. I think people are willing to buy clothing a lot online, but a lot of people want to try shoes on in person. They want to see them, feel them, test them out. And even if they start to go online, Foot Locker and East Bay have a strong presence online for their websites. And this is a company that has pretty good revenues here. So you can see it went up from about 7.5 to 8 billion. Their net income has been pretty good, around 500 million, 400 million. Like I said, this is a $3 billion company, so when they have a $500 million net income, that's really significant. I mean, that's a really good number to hit. For example, their EPS was about $4.50, and it's a $27 stock. I mean, that is a really good ratio there. Their balance sheet also looks really good too. Their total cash is sitting around $1 billion. I mean, they're a $3 billion company, so that's pretty awesome to see. They also have about $1.5 billion in the inventory. They also have some other assets too. So total current assets is about $2.7 billion, and their current liabilities are about $1.6 billion. So that's not too bad overall when you consider how much cash they have on hand. And I think that once we reopen the economy and sports reopen, they're going to do quite well. There's going to be a lot of people that want new shoes. They've been wearing them out and about just because a lot of people have been outside over the last few months, but they haven't really been able to play sports. So once they kind of need shoes to perform well or other clothing, they'll probably turn to Foot Locker, Champs, East Bay to buy more stuff for their school sports. So I appreciate it. Thank you guys so much for watching. Let me know what you guys think of these 6 stocks below. If you've made it to the end, let me know in the comments below too, because that's amazing. I know this is a little bit of a longer video, so I appreciate it. Thank you so much. Again, check out those links to M1 Finance and to WeBull in the links below. And there is a link to my Patreon too if you want to join that. You get access to our Discord. We have 4 members as of recording this video. So we talk about different stocks and different opportunities there. I tell you guys when I'm going to buy my stocks and what stocks I'm selling and buying and when I buy them and sell them. So I appreciate it. Thank you guys so much for watching, and I'll see you in the next one. Bye.